the process really needs to be just like it was in '08 when I went through this. First the equity has to go. And that's going to make its way into the 401ks, pensions, retirement plans, insurance, all that stuff. Because
And would that require a wave of foreclosures or some kind of public signal that this is going on, or can this be worked out in private? Can it be like just a bespoke arrangement? Will we get a sense that this process is moving in that direction?
That's a great question. It's going to be done mostly privately. It's going to show up, however, in obviously people's statements, in their quarterly statements, and I don't think people really understand it. That there's nothing that can be
Nobody
fixed.
understands this at all. It's a really opaque process, which is why we're all kind of looking for help
Yep.
here.
It can't be fixed, and here's why. The only thing that can fix it, Jeff, is lower interest rates. That's it. Because what happens is the values, when rates got down to basically zero, it created a bubble, and people bought at that price. It's really that simple. And so the prices were significantly higher 2 years ago, and I would say that they're 20 to 30% less, maybe even 40 in some cases. And it depends on the asset class, but so if you're a long-term holder and you're cash flowing, it doesn't really even matter. It's almost like buying a home and you're still making the payment and the value went down. It's not a big deal if you don't have to sell. It really isn't. And the issue becomes if the loan or the debt matures, so mostly on the loan side. So those commercial banks that lent, and mostly these are small and regional banks that lend on this money, they are exposed significantly depending on what they've loaned into. So if they've loaned into the office building market, that's getting clobbered because of the work from home and, the vacancies. I mean, I was talking to a guy this weekend. He had an office building in San Francisco and one in Phoenix, and his rent was $1 million a year. And he wasn't even going there because his employees now all work from home. So he's just waiting for those leases to burn off. And so you're starting to see these leases burn off, and there's a lot of folks that they've changed the way they do business, and they're not going to go back into these office buildings. What that does is it lowers the occupancy. Of course, and lower occupancy means lower revenue, and so now they're going to struggle paying just your normal expenses, which are taxes, insurance, utilities, and all that, in addition to the mortgage. So, there's a certain break even on these buildings, and they're probably in the 50 to 70%, depending. Now that would be debt plus expenses, and once you start to get your revenue below that, you're in default.